Module 7, Conclusion and Summary. Part 1. Recap of the key points covered in the course. Throughout this course on capital market trading, we covered several important concepts related to stocks, forex, stock indices, discretionary trading, and algorithmic trading. Here is a brief recap of the key points covered. Capital market trading refers to the buying and selling of financial assets, such as stocks, bonds, and currencies, with the goal of making a profit. Stocks are ownership stakes in companies, and their value is determined by supply and demand in the market. Economic and financial news can impact the demand for stocks, and traders can use various strategies to take advantage of these movements in price. Forex trading involves buying and selling currencies with the goal of making a profit. Exchange rates between currencies are determined by supply and demand in the market, and traders can use various strategies to analyze market data and execute trades accordingly. Stock indices are benchmarks that track the performance of a group of stocks in a particular market or sector. They can be useful for traders looking to gain exposure to a particular market or sector without having to buy individual stocks. Discretionary trading involves making trading decisions based on a trader's judgment and experience, rather than relying on pre-programmed rules or algorithms. Successful discretionary trading requires discipline, patience, and an ability to control emotions. Algorithmic trading involves using pre-programmed rules and instructions to execute trades automatically based on market data and other factors. It can be a valuable tool for traders looking to execute trades quickly and efficiently, particularly in high-volume markets. By understanding these key concepts and the various strategies used in capital market trading, traders can make more informed and effective trading decisions, ultimately leading to improved performance and profitability.